Howdy there, folks. Welcome into today's video. I have some pretty bad news to share in regards to the stock market. Well, you could look at it one of two ways. You could look at it as bad news, as in like, you could lose some money short term, or you could look at it as good news, as some pretty extraordinary buying opportunities out there. And I kind of want to explain what's going on here, how this process is going to roll, how this is all going to work out, where the opportunities are, and those sorts of things in today's video. First off, let me just cover this. I woke up feeling just burnt out today, just straight up, man. Like, sometimes you just wake up and you're like, I don't have it today. That was me today. I just woke up feeling burnt out. This part of earnings season, usually when we're at the tail end here, it is just like wearing is the best way I can put it. Very, very wearing. I mean, almost every single one of my stocks is reported. I probably own like 25 different stocks or so. So I got to listen to all those conference calls. I got to listen to all these other random conference calls that I'm looking for companies to potentially buy in the future. I'm looking to hedge against. Obviously, I have to keep in track with all these other important macroeconomic related companies. It's a lot, man. And then obviously, with YouTube and everything I got going on here and running the private stock group, it's that time when you just start feeling like you got to push through it, man. And I felt like this sometimes at Quick Trip. You just wake up one day and you're just like, dude, I don't have it today, man. But you're like, I got to push through. I got to give it my best, and we'll make do with what we got to make do. So appreciate everybody joining me as always. Thanks so much for being here, folks. And, years like last year, this is why I do this stuff. Like those opportunities of buying stocks at tremendous prices last year. That's why I put in all this work, right? Years like this year, when you see the fruits of your labor and your returns are astronomically high, like that's why I put in all this work. It's not to be forgotten. It's a lot of work. It takes a lot of time. It takes effort. It takes a lot of mental strain. And certainly in my position that I'm in, if I make a wrong move, obviously, there's a lot of people that are just waiting on me to make a wrong move so they can make fun of me and, call me names and all those sorts of things. And so, it's not for the faint of heart. Let's just put it that way. It's big boy shoes to fill, and it's a whole process to go through. And so when you get to this part of earnings season, I'm just about ready for it to be over, because it is it's brutal, man. It's absolutely brutal. So every single night, listen to 2-3 conference calls. Like I said, this game's not built for everybody, okay? So appreciate you guys being here. Thanks for being subscribed, and let's get into this, okay? So first place I want to start today's video is Rivian. There's a very important reason I'm starting this video with talking about Rivian, okay? So if you didn't know, Rivian just reported earnings here about 2 hours ago or so. And it's very interesting because, Rivian's really the only EV-related company I believe in other than Tesla. This is a stock I've talked about where, if you told me I was forced to buy another stock that's EV-related, I would buy Rivian and really nothing else, right? And when it comes to Rivian, so they reported a loss for the second quarter, but that was much better than expected. They also said they're going to build 52,000 vehicles for 2023, which is more than twice the number of last year, and which is above where they were thinking they were going to be at, okay? And also, they have still a pretty big cash stack on the company of over $10 billion, right? So they delivered 12,640 vehicles during the quarter. That's up 59% from the first quarter total, as well as 4,467 EVs it delivered in the second quarter of 2022, right? So incredible growth. It produced almost 14,000 vehicles in the quarter, up from about 9,300 in the first quarter of this year, right? And that's versus 4,400 at the same time last year. So very impressive numbers. Their adjusted loss came in way ahead of expectations. They had an adjusted loss of $1.08 versus $1.41 was expected. They had revenue come in at $1.12 billion. So they were expected to do about $1 billion. So they beat by about $120 million in terms of revenue line item. It's very, very impressive. And so I got to say, this is impressive. Now, where this gets into a little troubling territory here is you see something like this, their guidance is expected to be better than anybody thought. Their losses are coming in better than anybody thought. Their revenue is higher than anybody thought. A lot of things in the right direction here with Rivian. It's actually looking pretty promising when it comes to Rivian, right? And so you might think, well, this stock has to be up, right? It has to be up nicely, because this stock is still a stock that's been slaughtered. If you look at where the stock was a couple of years ago versus where it is now, it's having trouble even eking out gains in after hours. And I've even seen it turn red sometimes in after hours trading, which goes to show you something very important. And what this goes to show you is the market still believes there's likely a big recession coming, or at least a medium-sized recession coming. And that's why you can't get any of these sorts of companies to catch a bid, really, in a meaningful way, right? You say, well, it's come from $12 to 25. Yeah, okay, this stock is still in kind of a joke place from where the stock was, obviously, previously, right? And you even look at Ford earnings. Ford earnings were amazing outside of the EV division. No one bought Ford stock. No one bought that stock, even after those amazing earnings other than the EV division, right? Because a lot of people look out there and they say, we're not so convinced we're out of the woods when it comes to the economy yet, okay? And therefore, we're not really ready to take risk. And you even look at a stock like Tesla. Yes, Tesla's had a tremendous year, right? And a lot of shareholders like myself and probably some of you guys have, made a lot on that one this year. But let's not forget, Tesla's a long flipping flapjacking away from all-time highs, okay? A long way. And that's even with Cybertruck coming and all the excitement around Tesla, and Elon's always in the news and all those sorts of things. But a lot of people look out there and they say it's going to still be tough sledding for maybe years to go in the future for anybody that produces vehicles, right? Now, this leads me to talk about Palantir, right? Palantir. So we covered yesterday, obviously, the extraordinary move after hours, which was pretty crazy, right? Huge volume dump, and then, stock just dumped, right after the earnings came out. Then it came back strong in after hours trading. And I will say, I think retail really saved that stock after hours. I was looking at, on NASDAQ's website, you can see actually the trades going through for who's, you can't see who specifically is buying shares, but you can see like the amounts and the totals. And it was a lot of smaller amounts. I saw 100 shares, 500 shares, 1,000 shares, 50 shares, like smaller increments of Palantir kind of being bought up in that after hours. I wouldn't be surprised if retail is the one that saved it after hours, right? And then somebody still dumped in the pre-market, and so the stock opened today about 16, and it came back throughout the trading day. I think retail saved this one. It looks to me like, I don't know if Wall Street was trying to get this one down, or maybe they just don't believe in it at the moment, or something like that. But what this story spelled out between what happened after hours and what happened today in the trading day is Wall Street doesn't want it, retail loves it, okay? That's what this kind of smells to me, okay? Now, it's fascinating because one of our subscribers, Gordo, got to give a shout out to him. He called this yesterday. He called it, and I remember seeing this comment. I was like, damn it, Gordo's probably going to be right on this. And sure enough, he says, I think the initial sell-off will prove the correct reaction, right? And he was right on, because it ended up opening today literally right where that after-hours trading was. But like I said, I think retail really bought this baby up. The question is now, who's left to really buy this baby up the way it's going to need to be bought up if Wall Street continues to dump? So that's where you get into a very interesting dynamic that it's going to be kind of tough sledding for Palantir. Palantir really needs Wall Street money to come back in this baby to start pushing up the shares again to get back, to 20 and then obviously above 20. Your retail is not going to be able to carry it the whole way there, okay? Now, I'm seeing some stuff in the Palantir community that's really frustrating to me, and I got to just speak on this for a moment because it needs to kind of stop. I'll be honest. It's creating a dynamic where the Palantir community has so many incredibly intelligent individuals in this community, right? But unfortunately, there's a few people that, in my opinion, are shifting the narrative and almost trying to take the stock into like meme stock territory. We don't want any part of being a meme stock. This is no AMC, this is no GameStop, this is none of that garbage, okay? But it feels like the way I'm seeing some individuals act in this community, it feels like, are we trying to take this to meme stock territory? Like, what is actually going on here? And it's quite frustrating for me to see what's going on out there, okay? So some of the stuff I'm seeing out there, right? I think if you're going to speak on Palantir, put up your shares. Show us what you own. Show us your lots. Like, show what you actually got in this stock, okay? Because it kind of frustrates me when I see all this crazy commentary on Twitter, YouTube, everywhere, and I'm just like, what are these thoughts coming from, right? A big individual yesterday does, Palantir is going to 10x, video, and it's just like I don't even know if that individual owns this stock. I've never even seen them talk about this stock, and I'm like, what? Another big individual, I saw this, where was this? This is either Threads or Twitter or somewhere. They're saying, this was the best conference call they've ever heard. And I'm like, have you ever heard a conference call? I'll be flat out honest. The Palantir conference call yesterday was okay. That was the best it was. Okay. It was a very average, kind of conference call. This was no amazing conference call. As somebody that listens to 50 to 100 conference calls every earnings season, I can tell you this was not even remotely the best conference call of this earnings season. This wasn't even the best conference call probably I've ever heard from Palantir. It was very okay. It was a lot of, excitement talk. Excitement talk does not mean great conference call, okay? It is a whole different territory. And Alex Karp made a huge mistake on that conference call. I mean, a mistake that as soon as I heard that, I was like, ugh, what are you doing, Karp, okay? He said this, okay? He said, basically they're talking about, obviously their artificial intelligence platform, right? And he says, we have no problem monetizing. He says, we will figure out how to monetize it. As soon as I heard that, I was like, dude, oh my gosh. Like, what are you doing? Like, you have a lot to learn about Wall Street, because this is not what Wall Street wants to hear. That's fine if you're with your buddies and you run a small business and you're like, I think I'm going to start this new product and service, and you're throwing back some beers and you're like, we're going to figure out how to monetize this thing somehow. Not on a conference call as a, $30, $40 billion company. Like, no, okay. You can't just be like, we'll figure out how to monetize it. Like, no, okay. It's just like immediately how Wall Street takes that is like, this guy's clueless. Like, he doesn't even know how they're going to even monetize this thing. So how are we going to model any numbers for it if he doesn't even know how they're going to monetize it, right? And so it's kind of almost like a disheartening thing. And so anyways, that Palantir conference call yesterday was very okay. Anybody that's trying to pump this thing as the greatest conference call ever, like I said, just doesn't have experience listening to conference calls, because that was not a great conference call, bottom line, in regards to that. Now, I haven't pulled up Yardini numbers in a while for you guys, and I got some very important things to show you guys here. And this matters significantly for the way the stock market's going to perform moving forward, how valuations are going to go. And there's a few scenarios that are going to play out here, and none of them are good. That's the problem. Like, there's a few scenarios that are going to play out. There's like 3 real potentials. None of them are good. Okay, none of them, for the short term at least. Okay, meaning short term, for me, I'm really talking about the next 6 to 12 months, not talking about the next 6 to 12 years, the next 6 to 12 days. Okay, so if we go ahead and look at forward Ps of large caps, we have a problem, folks. Large caps valuations have now climbed immensely again, right? And as this year's ticked on, large cap valuations have been blowing up. And now we're at a 19.2 S&P 500 large cap valuation for forward Ps, okay? This is a problem. This is a major problem. The problem is we have the least attractive risk reward we've seen since the year 2000. Scary. We don't have as big of a bubble going as we had in 2000, but this is not an attractive risk reward time. To buy a large cap S&P 500 stocks right now is a very bad risk reward, extremely bad, and I don't think people even realize how bad it really is, okay? Here's a way to look at this, and here's why this matters significantly, okay? So obviously, you should usually pay for S&P 500 large caps around a 16 forward P, roughly, right? If you can get a great pricing, like obviously we're getting back in 2010, 2011, you can get a forward P of like in the 10 to 12 range. That's incredibly, the risk reward there is extremely attractive if you can get that, right? But usually around a 16 is pretty fair. When you start talking about 19 plus, you're talking rich, but here's a problem. We're trading richer today than we were back here. Why is this? Here it looks higher than here. Why are we trading richer? 2 reasons. At this time, you had, there's a reopening, so this is going to be a huge boost to companies' profitability over the next several years, and this is going to be great, right? And that was a component. The second component you had is, where was the Fed funds rate then? The Fed funds rate was 0 then. 0, 0, like Robert De Niro. What happened to my camera? Okay. Well, freaking move. That's fine with me. At this point in time, I don't even care. We'll move. Wherever you want to do cameras, whatever you want to do, we can make it happen. We'll move over here. At this time, Fed funds rate was 0. Now we got a Fed funds rates of 5% plus, right? At this time, there was nowhere to put your money. So you say, well, we kind of got away with it between, the excitement about reopening happening, right? Coming off of the Rona closures, and there's nowhere to put money, and there's all that stimulus. Well, the problem is, now there's no stimulus. Now there's places to put your money and get 4 to 5% guaranteed easy money, right? Savings account, treasury bills, those sorts of things. And we're already at max employment. Like, it doesn't get better than this. We're in the threes right now for unemployment rate, right? So it gets no better than this. And so the risk reward right now for large cap S&P 500 stocks is just bad, man. It is, like I said, it's the worst I've seen since 2000. And that's a very troubling situation. And so, this is a situation you have to be very selective with where you're putting money in this market, extremely selective. This is not just an easy time period like we had for many years where you can just throw money in anything in the S&P 500 and you're going to be good on that, right? It's a very different scenario. A really bad setup, a really, really bad setup for us, okay? And so there's a few scenarios that are going to play out here. One is the bubble grows, and then we have a tech-like bubble, right? So that's one scenario. Another scenario is we flatline for several years, right? Let's say we have no major recession. Let's say unemployment stays in the 4-ish range or under that entire time. So for the next several years, we kind of just stay flattish, or we come down as far as valuation because companies just get more and more profitable. That's a potential, right? That's kind of like the Goldilocks scenario. Or there's going to be a rotation of money from these guys to maybe some of the smalls and mids, right? Which is going to obviously bleed large caps, which would ultimately kind of bleed the indexes in general, right? Or we're going to have a drop in the market. So almost all the scenarios are bad scenarios for the next several years for large cap stocks. None of those scenarios are good. Like, the best case scenario is a stagnation. A stagnation, folks. So think about that for a moment. Let that sink in, okay? And so be very selective with where you're putting money in this market, right? Now, that leads me to my next point to talk about here is construction, right? So we know that obviously the federal government has their big infrastructure bill going on, and that's going to last several years as far as, fixing roads and highways and airports and all this stuff. That's great, okay? But the issue is that's only one segment of the construction market. A huge segment of the construction market is all the big infrastructure projects that are not like federally government funded projects, right? The amount of apartments being built, the amount of homes being built, the amount of warehouses being built, the amount of retail space being built, restaurants, all those sorts of things, right? And so all that's pretty much like private money type stuff. Now, we've been in a huge boom for pretty much 10 years in regards to all those things I just named there. Literally, for the last 10 years, we've been in a major boom for all that stuff, okay? Major boom. And it's been a beautiful thing, right? Well, the problem is a lot of this is coming to an end. All this cheap money is gone bye-bye now. So if you're going to talk about major projects in 24 and beyond, it's going to be few and far between because it's going to be hard to get that sort of funding. Not only that, especially if credit tightens further, right? But not only that, the interest rate environment is so much different. And so to get a positive ROI is a very, very tough dynamic, especially where wages are at and the cost to build. And so I think there's a potential that we could go through several years of a very weak construction market. Remember, I just said several years. We're not talking about this is just a few months. I'm talking about years of a very weak construction market, which is something we certainly went through from about 2008 through about 2011, 2012. We went through a very weak construction market for many, many years, right? And so, the big federal bill is only going to be able to help out so much in regards to that, right? And, I'm even worried for my own city in terms of this, right? And I kind of live in like the Tesla of states. Like my state is like the Tesla states. It's always growth, right? Because we have, California is a mess, right? And so we always have these California folks moving here. Obviously, we're seen as, a good climate place. Taxes, no state income taxes, and a lot of retirees like to move to Vegas too. No, it's not as popular as like Arizona, Florida, but, just Nevada in general attracts a lot of retirees, and specifically Vegas. So we've had it. We're in a very special situation. And so when I think about the rest of the United States, I'm thinking like construction could be tough for a while, right? And, you think about all the apartment complexes that are being built and all the homes and things like that. I think we're way overbuilt. I know, this data, you can show this data or that data and say, we're not overbuilt. I think we're way overbuilt, guys. I think we're way overbuilt, like as in it's going to take years to fill up all the demand across the board. Because do remember, when you go through a weaker economic environment, people move in with people, they move out of homes, homes get foreclosed on, you have short sales happen, apartments get moved out of, right? And so you have that whole dynamic, and more people kind of like living together type situations. Let's just call it that, right? So I believe we're actually getting way overbuilt now at this point in time, like way overbuilt. And, let me tell you guys a little story, because you might think this can't happen. Like, whoa, what is this all way overbuilt thing? When they were building like crazy, which, by the way, building like crazy is actually a relatively small number compared to the way they've been building recently, especially in regards to like apartment complexes and homes and everything like that, right? They thought back in 05, 06, like this is all, right. Like we're building the right amount of demand. We need to continue to build a lot more homes and apartments and all this stuff, right? Great financial crisis comes, and they realize, no, we way overbuilt. And not just like by a little bit, by a lot. But at the time, they thought they were doing the right thing. Oh, this is all, the way it's supposed to be. We're building the right amount, right? And, let me tell you a story about the first apartment I ever moved into, okay? It wasn't called this back in those days. It's called Metro at Zanjero, okay? It was the first apartment I ever moved in when I moved out of my parents' house in 2011, right? And the interesting thing with this building was it actually wasn't built to be an apartment complex. It was actually built to be condos. But it was built, kind of leading up to the great financial crisis, and I think a lot of people just kind of walked away from their down payments and stuff. It was built in kind of a cool area where the new Cardinal Stadium was going to be at and all these sorts of things, right? And so some other company ended up taking over. I don't even think it was this Graystar company back in those days. Some other company ended up taking it over, right? Put it into apartments, right? And so I get this really beautiful apartment. I don't even know if it was ever lived in prior to me living in it, right? And, they were so happy to have me as a tenant. It wasn't like it is been over the past few years where, you feel lucky to find an apartment or something like that. Back in those days, it was like, man, they welcomed me with open arms. And it was $750, and they were so happy to just have me as a tenant, right? And that was, by the way, that was kind of an expensive price back in 2011 for that one bedroom. It was like 800 square feet. Now those are like, $1,600, those same apartments, right? And I remember, sometimes on my off days, I'd go swimming in the pool and just, by myself. And it's just like, well, most of the time it was by myself. A few times it might have been with other individuals, but most of the time it was by myself. And I just had this whole massive pool. I'd just be swimming back and forth on my off days from Quick Trip and stuff like that, and just like loving life, man, loving life. And why was it so dead? Well, because there was a ton of vacancies. And this was something that they thought was going to be all filled up as a condo community. They couldn't even fill it as a condo community because the recession hit. And then they had to move it into apartments, and then it took them years to get that place to full vacancy. I remember there were several different options I had when I moved in there as far as, what apartment I wanted. It wasn't like there was one apartment to pick from. There was a lot on different floors I could pick from, and this one's coming available, this one's available, this one's available. So, this is what can happen. And a lot of people didn't go through the great financial crisis, so they don't really know how this stuff works, or the cycles and the ups and the downs. And, it all plays out over time. And so you just, you got to have kind of patience with these things, okay? Now, there's a few things you can do in the market, okay? There's a few things, because I think there's significant risk in the market. I think there's some tremendous opportunities in this market, but I think there's also significant risk to many things, okay, over this next, we can say, year or so. So one is you can hedge, okay? Make sure you have some hedges in your portfolio, especially if you have a big portfolio. If you got $5,000 invested, do you need a hedge? Probably not, unless you really just want to learn the skill now when you have a smaller amount of money, which is always a good thing. But, for folks that have, there's a lot of people that watch my channel, and a lot of you guys have, 6 figures, 7 figures. Some of you guys have 8 figures in the market. You're all long, and just like, what are you going to do in a scenario where, the S&P 500 goes down considerably, right? And it's down for a year or two. Right? Not like it comes back right away like it did in the Rona crash. Like we're down, and it's like down and down and down and down and down and down for a while, right? What do you do in a scenario like that? What if the S&P 500 went down for 3 straight years? What would you do in that sort of scenario? I'm not saying that's going to happen, but you just got to think about these things, right? And when you think about, the sort of cycle we're in right now, right, of unemployment being as best as it can possibly be, when you think about where Fed funds rates at, when you think about where government debt's at, is, there's a lot. I mean, the amount of risk I could go through in a video is startling, right? So to have a little bit of money hedged can go a long way if you do it properly. It can go a long way in case you get some sort of big downside scenario event, okay? Now, another way of hedging, if you don't want to go a way of buying inverse calls on, let's say, an inverse index, or if you don't want to buy puts, you don't want to do some sorts of option strategies and things like that. Another way you can do is just hold a heavier level of cash, which is nothing wrong with that, because right now you're able to get 4 to 5% on your cash if you got a good savings account. If you're putting in shorter term treasuries or something like that, you can get 4 to 5%. So it's not like you're getting nothing in this market. So the risk reward actually for if you can get 4 to 5% guaranteed right now is actually pretty darn attractive. So there's 2 routes you can go. I'm actually doing a combo of both right now. I'm buying stocks on a weekly basis, some very specific opportunities I see in the market. I'm also adding hedges for 2024 now at this point in time. I've just started really in a significant way today, and then I'll continue for the rest of this year, essentially every single month adding hedges, okay? And then I'm also holding cash, getting my 4% I get on my cash in my savings account, okay? So you can kind of do a combo strategy, but this is not the sort of market you really want to be all FOMO, all just, it's up and up forever and ever, because I can tell you there's significant risk, and the market's not pricing in that risk right now. If the market was pricing in that risk, then you can say, well, let's go for it, right? Like 2009 is a good example, right? 2009 is so much risk because so many things were going bad and so many things were wrong, but the market was priced on the floor. So the risk reward there was so amazing, right? Right now there's so much risk in the market, and yet stocks are trading so highly valued when it comes to large cap. That's the problem we have, right? Big problem. And be very selective with where you're putting money in this market. I mean, extremely selective, guys. This is not a time when you just throw money on anything. You need to be throwing money at the best of best opportunities over this next 3 to 5 years. These sorts of stocks that can weather a real recession. I'm talking unemployment 7, 8, 9%. That type of recession. The companies that can get through, that have the balance sheets to get through to that other side, that could even stay profitable in some sort of recessionary scenario, right? And best case scenario is that it never comes. And this massively inverted yield curve, it just becomes nothing. And, all the telltale signs of that we're going to end up in a big recession in 2024. Let's say it never happens. Great. Sweet. This time was different. We could say this time was different and it happened, right? And the Fed lowers rates and, oh my gosh, we have a no landing or soft landing. And it's beautiful. And we'll be able to always say that time was different than all the other times. But it might not be different. And so that's why you got to be extremely selective right now and really, really consider some hedging. Either cash or a little bit heavier, or consider a scenario where you're buying puts or some calls and some inverse ETFs, okay? That's my 2 cents. I appreciate everybody joining me as always, folks. If you're looking to take your investing game up to a much higher level than where you're at currently, and you think this is something you want to take more serious, check out my private group. Apply for that. I'll have that as a pinned comment here today. That teaches you everything you could ever possibly want to know about this game of investing and building your portfolios and hedging. I have so many different, and you get to track what I'm up to in the market and see all those sorts of things. Today, I put on some hedges here today. You get to see what I'm up to in my portfolios and how I run this game, because it's we're in a more complicated game right now, folks. I can tell you that. We're going to be, and then this game's not over. It's going to be a more complicated game for the next 12 to 18 months. I appreciate it, everybody. Much love as always. Thanks for being subscribed, and have a great day.